It is 7:15 in the morning. The gates of a manufacturing plant are already open. A few trucks are waiting outside. Workers are walking in. Inside the factory, machines are running. Nothing about the scene looks extraordinary. But an investor standing outside that gate is watching something very carefully. Not the stock price, not the quarterly result, not the television screen showing the market. He is watching the trucks. Because over the last few months, something has changed. The number of vehicles coming in has increased. Suppliers seem busier. Customers are placing larger orders. And competitors are beginning to react. None of this appears clearly on a stock chart. Yet these small observations may tell us something important. The question is not, is this stock going to rise? The better question is, what is changing inside this business? That question can take an investor much deeper than a price screen ever can. Because the market gives you a number, the business gives you a story, and the difference between those two can sometimes be enormous. Philip A. Fisher's investment thinking was built around this kind of investigation. But the real lesson is much broader. A serious investor should not be satisfied with knowing what a company reports. The investor should try to understand why the business is behaving the way it is behaving. Imagine discovering that a company's sales are rising. That sounds positive. But why? Are customers genuinely choosing the company's products? Is the industry itself growing? Is the company taking business away from competitors? Has the company launched something new? Has distribution improved? Or is the recent growth simply the result of a temporary cycle? The number tells you what happened. The investigation tries to discover why. And that distinction can completely change the investment decision. Because an observation is only a clue. It is not a conclusion. Suppose a company's revenue has grown rapidly for 3 years. The natural reaction is excitement. Revenue is rising. Profits are rising. The stock is moving. It is tempting to connect all these dots and conclude that the company has become a great investment. But growth itself is not enough. A small company can grow quickly because it is starting from a small base. A much larger company needs a much bigger opportunity to maintain the same pace. Think about a small restaurant. Opening a second outlet can transform the business. But going from 100 restaurants to 200 requires an entirely different level of opportunity, capital, and execution. So the real question is not simply, is the company growing? It is, how much runway is left? Growth needs space. It needs customers. It needs new markets. It needs products. It needs distribution. And it needs management capable of handling the next stage. But there is another problem. Investors often take what happened recently and quietly assume that it will continue forever. The last 3 years become the next 5. The recent margin becomes the permanent margin. The current growth rate becomes the expected growth rate. And without realizing it, the investor stops analyzing the business. He starts extrapolating the past. That is where a good story can become a dangerous story. Because even an excellent company can become a poor investment if expectations become too high. Imagine someone offers you a beautiful house. The neighborhood is improving. The roads are getting better. New businesses are opening nearby. Everything looks promising. But then you ask, how much are you asking me to pay? Suddenly, the conversation changes. The house can be excellent. The neighborhood can be excellent. The future can be excellent. And yet the purchase can still be a bad deal. Stocks work in much the same way. The question is never simply, is this a good company? It is, what am I paying for the future of this company? And that leads to an even more important question. What future is today's price already assuming? If investors are already expecting extraordinary growth, ordinary success may not be enough. The company may perform well. Profits may increase. The business may become stronger. And the stock may still disappoint. This is one of the strangest realities of investing. Sometimes the business gets better, but the stock does not. Sometimes the business performs exactly as expected, and the stock barely moves. And sometimes the business improves far beyond what investors had imagined. That is when the market can dramatically change its opinion. Which brings us back to the business itself. What does this company do better than competitors? Is that advantage temporary? Or can it last? Why do customers stay? Is it because of price, quality, convenience, technology, distribution, brand, or simply because switching is difficult? And perhaps the most revealing question: what is management doing that competitors are not doing? Two companies can produce similar financial numbers, but their futures can be completely different. One management team may constantly search for new opportunities, improve products, strengthen distribution, enter new markets, control costs, develop people, adapt to change. Another may simply operate the existing business and hope conditions remain favorable. Over several years, those differences can become enormous. That is why understanding a company sometimes requires going beyond financial statements. You may need to understand the customers, the suppliers, the competitors, the distributors, the employees, the industry, the conversations happening outside the boardroom. Because businesses are not spreadsheets. They are living systems. Customers change. Competitors react. Technology evolves. Costs rise. Products become obsolete. New opportunities appear. And management has to respond. This is also why a company should never be placed permanently into one category. A small growth company can eventually become a large mature company. A cyclical company can temporarily look like a spectacular growth company when conditions are favorable. A turnaround can look attractive simply because the stock has fallen sharply. An asset-rich company can remain undervalued for years if those assets are difficult to unlock. The label is only a snapshot. The business keeps moving, and the investor has to keep asking new questions. Consider a company whose stock has fallen 50%. The first thought is often, it has become cheap. But cheap compared with what? The previous price? Its assets? Its earnings? Its competitors? Or simply our emotional memory of what the stock used to be worth? A stock falling from 1000 rupee to 500 rupees does not automatically make it attractive. If the business has deteriorated badly, 500 rupee may still be expensive. The price has fallen, but the value may have fallen even further. This is where investor psychology becomes dangerous. Once we buy stock, we naturally want to be right. We start looking for evidence that supports our decision. Good news feels important. Bad news gets explained away. A temporary problem becomes an opportunity. A competitor becomes irrelevant. A disappointing quarter becomes short-term. Soon, something subtle happens. We stop investigating the company. We start defending it. And that is a dangerous transition. A better approach is to reverse the role. Instead of becoming the lawyer for your stock, become its prosecutor. Ask, what could destroy this story? What assumption am I making? What happens if growth slows? What happens if competition becomes stronger? What happens if margins return to normal? What happens if management makes the wrong decision? What happens if the expected opportunity never arrives? And perhaps the most uncomfortable question, what evidence would prove me wrong? These questions are difficult, but they are useful because research is not about collecting reasons to buy. It is about discovering whether your original thesis survives serious questioning. There is another trap investors often fall into. They confuse an attractive product with an attractive investment. You may love a company's cars. You may use its software every day. You may see its restaurants packed with customers. You may admire its brand. But none of those things automatically tell you what the stock is worth. The business has to convert popularity into economics. Customers must become revenue. Revenue must become profit. Profit must become cash. And that cash must be used intelligently. That chain is where the real story lies. Sometimes the most important clue is not a new product. It is a change in behavior inside the business. Customers may be buying more frequently. Distributors may be giving the company more shelf space. Competitors may be losing customers. The company may be entering a new market. Or costs that once prevented strong profitability may finally be spread across a much larger revenue base. Suddenly, additional sales begin contributing much more to the bottom line. The business starts behaving differently, and eventually, the market may notice. This is where the stock price becomes interesting again. Not because the chart predicts the future, but because price behavior can sometimes confirm that something inside the business is changing. A stock that has struggled for months may suddenly stop reacting negatively to bad news. Buyers may start appearing consistently. The stock may begin behaving differently. But even then, the investor should ask, why now? If the business is improving and the market is beginning to recognize it, the price action becomes more meaningful. The chart becomes confirmation of behavior, not the entire story. That distinction matters, because the most dangerous investment process is to start with a chart and then invent a story to explain it. A better process is often the reverse. Understand the business. Understand what is changing. Understand what could happen next. Then see whether the market is beginning to recognize that change. And sometimes the market gets it wrong for a very long time. A good business may remain unnoticed. A mediocre business may become fashionable. A company's potential may take years to appear clearly in reported numbers. This is why investing requires patience. But not passive patience. Investigative patience. The patience to wait for evidence. The patience to keep asking questions. The patience to accept that the market may not agree immediately. And perhaps most importantly, the patience to walk away when the evidence stops supporting the thesis. Because good investing is not about being permanently loyal to a stock. It is about being loyal to the facts. The moment the facts change, the story must be reconsidered. Think back to that factory gate. The trucks were never the investment decision. They were simply the first clue. The investor still had to ask, why are orders increasing? Who is placing them? Is the increase temporary? Are competitors losing customers? Is capacity expanding? Can the company maintain its advantage? What does management intend to do with the opportunity? And finally, is the stock price already assuming all of this? That is the difference between noticing something and understanding something. A rising sales number is an observation. A popular product is an observation. A crowded factory is an observation. A rising stock price is an observation. None of them is a conclusion. The conclusion comes only after the questions. Why is this happening? Can it continue? What could change it? What could prove the story wrong? And what are we paying for that future? The market will always give you a price. The chart will always give you movement. The headlines will always give you excitement. But underneath all of that is a business. And that business is constantly telling you a story. The investor's job is not to predict every twist and turn. It is to learn how to read the clues. Because sometimes the biggest opportunity is not hiding in the price. It is hiding in something quietly changing inside the business. A new customer, a new product, a stronger competitive position, a better management decision, a new market, a change in economics, or simply a company becoming much better while the market has not fully noticed yet. The price is what everyone can see. The economics are underneath. And once you learn to look underneath the ticker, you stop asking only, will this stock go up? You start asking something much more powerful. What is actually happening here? That question is where the investigation begins. And sometimes, the answer is where the real investment opportunity begins. Don't just watch the stock. Look underneath the price. Because every stock has a business behind it. And every business has a story. That is the story behind stocks.